Everything you think you know about silver, its value, its volatility, its future, is built on assumptions that are about to be shattered? What if the next Black Swan event, something unpredictable, devastating, and world-altering, arrives not through war, not through inflation, not through interest rate policy, but via a catalyst buried deep within the structure of global finance? A catalyst that could launch silver prices into territories no chart has ever captured. Not $50, not $100, not even $200, but multiples beyond what even seasoned analysts dare whisper. Today, we explore a story not just of supply and demand, but of unseen forces, historical echoes, and systemic pressure points that may propel silver to a runaway surge the world has never seen. Silver through history. To understand where silver is going, we must first understand where it came from, and why it ever mattered. Ancient civilizations. Silver was one of the first metals humans smelted, traded, and standardized into coinage. Its value came not only from its shine, but because it was scarce enough to matter, yet common enough to circulate. Silver is money. Coins became contracts, proof that someone owed someone else something of lasting value. For centuries, silver served as that proof. The rise of banking. Carrying sacks of silver became impractical. Enter the first banks, and with them, paper promises. Banknotes were claims on silver stored in vaults, the foundation of trust in early financial systems. The system worked until it didn't. The gold standard era. By the late 19th century, gold became the backbone of international finance. Silver became secondary but remained significant, money tied to physical metal-anchored economies. By the 1970s, the gold standard was abandoned. Paper money became fiat, a promise of value backed not by metal but by trust. Silver's monetary role was diminished, or so the world believed. But here's the twist. Silver never fully lost its role as a monetary safeguard. It silently transitioned into a hybrid existence, part industrial metal, part hedge against systemic risk, part psychological safety net. And as history has shown time and again, periods of systemic stress can make silver explode in value when least expected. To understand silver's next potential surge, we must first trace its journey through history step by step, and see how cause and effect patterns shaped its value and role in society. Silver as the first money. Silver was more than a shiny metal. It was money itself. Early civilizations needed a medium of exchange that could survive over time and across distances. Silver's durability, divisibility, and relative scarcity made it the ideal candidate. Cause, the need for trade and standard value. Effect, silver coins became universal currency, circulating across continents and connecting civilizations. Merchants and temples became the first financial institutions, storing and lending silver. Wealth was physical, visible, tangible. But physical money carried risks, theft, transport costs, and storage challenges. These risks planted the seeds for innovation, and eventually, systemic vulnerability. Early banking, paper promises on silver foundations. As trade expanded, carrying silver everywhere became impractical. Banks began issuing paper notes, early banknotes that promised redemption for silver stored in vaults. This innovation was revolutionary. It allowed commerce to flourish without moving heavy metal. Cause, need for efficiency in trade. Effect, the birth of modern banking and the paper money system. But this system depended entirely on trust, that banks actually held enough silver to honor every note. Overleveraging and mismanagement created fragility. And history shows, once that trust is broken, markets can implode unexpectedly. The gold standard and silver's secondary role. By the late 19th century, gold became the global anchor of currency. Silver, though still important, became secondary. Governments pegged their currencies to gold to stabilize economies. Silver was relegated to smaller coinage and reserves, but its symbolic role as money persisted. Cause, desire for monetary stability. Effect, silver's prominence declined, but its psychological and investment significance remained. Central banks held silver as a backup asset. Citizens still viewed silver as a hedge against uncertainty. And here lies the first lesson. Even when silver seems sidelined, its latent monetary power never disappears. Breaking point. Fiat money and silver's transformation. The real turning point came in 1971, when the United States abandoned the gold standard. Paper money became fiat, no longer backed by physical metal. Silver lost its official monetary role and became a commodity, used in industry, jewelry, and investment, but no longer a direct currency. Cause, governments needed flexibility in monetary policy and to manage debt. Effect, a trust-based system replaced asset-backed currency, leaving silver's price influenced more by speculation and industrial demand than by official monetary policy. Mines could not instantly ramp up production to meet sudden demand. Supply constraints made silver highly sensitive to shocks. History shows that when trust in paper money falters, silver acts as a safety valve, surging in value to absorb market anxiety. Post-1970s, silver in a hybrid role. With fiat money entrenched, silver entered a hybrid existence. Industrial metal, electronics, solar panels, medical equipment, investment asset, ETFs, futures, bullion. Psychological hedge, a store of value in times of uncertainty. This dual role created unique vulnerabilities. Paper silver markets could be leveraged far beyond actual physical supply. Industrial and investment demand could spike simultaneously. The system became primed for volatility. A tiny trigger could set off dramatic price swings. Cause? Transition to fiat currency and industrial reliance. Effect? Silver became both a commodity and a quasi-monetary asset, highly sensitive to systemic stress. Systemic stress and historical silver spikes. History provides examples of sudden, explosive silver price movements. The 1980 Hunt Brothers, silver squeeze paper contracts, physical hoarding, and leverage created a historic spike. 2008 financial crisis. Fear, liquidity shortages, and safe haven demand caused silver to surge. Cause? Misalignment between physical supply and leveraged paper markets. Effect? Rapid, extreme price volatility. These episodes were not caused by silver alone, but by broader financial system stress. Silver acted as both a warning signal and an escape valve for market instability. From ancient coins to leveraged futures markets, the story of silver is one of recurring patterns. Scarcity creates value. Human innovation adds layers of complexity. Systemic stress amplifies volatility. In the next part, we'll explore modern parallels, the pressures building in today's financial system, and why history may be poised to repeat itself with a dramatic, unforeseen catalyst. The pressures building. Today, silver's story is not just a relic of the past. Its patterns echo loudly in today's financial system. The same forces that triggered historic surges are quietly building, and this time, the system is larger, more leveraged, and far more fragile. 1. Global debt levels. A ticking time bomb. One of the most striking parallels with past crises is the scale of global debt. As of 2024, total global debt exceeded $300 trillion, a figure larger than the entire world economy. Sovereign debt ratios in major economies rival or exceed post-World War II levels. Cause? Continuous government borrowing, corporate leverage, and low interest rates. Effect? Any sudden shock, whether a banking failure, geopolitical crisis, or policy misstep, can trigger panic in financial markets. History shows that when debt reaches unsustainable levels, traditional safe assets like paper currency falter, and physical assets like silver become destinations of choice. 2. Negative real interest rates, incentivizing precious metals. Another critical factor is real interest rates. Interest rates after adjusting for inflation. For much of the last decade, major economies have experienced negative real rates, meaning holding cash or bonds loses purchasing power over time. Negative real rates reduce the opportunity cost of holding non-yielding assets like silver. Cause? Central bank policies aimed at stimulating growth. Effect? Investors are increasingly drawn to tangible assets, creating upward pressure on silver prices. When fiat currencies offer no real return, silver doesn't just hedge, it competes for capital. 3. Industrial demand meets limited supply. Unlike in prior centuries, silver today has dual demand pressures. Industrial demand. Silver is essential in electronics, medical devices, photovoltaic cells, and automotive manufacturing. Investment demand, ETFs, futures, physical bullion, and coins. Cause? Technological innovation and renewable energy expansion. Effect? A structural supply-demand mismatch. Mining output cannot surge overnight. New projects take years to develop. Sudden spikes in investment demand can trigger physical shortages, amplifying volatility. This makes silver far more sensitive to shocks than gold, even in modern financial systems. 4. Market structure vulnerabilities, leverage, derivatives, and paper. Modern silver markets are dominated by paper instruments, futures, options, and ETFs, with physical silver as the underlying asset. Leverage amplifies every market move. Paper contracts can represent multiples of actual physical silver. Liquidity mismatches occur when too many investors demand physical delivery at once. Cause? Complex financial engineering and derivatives expansion. Effect? Small triggers can create outsized price swings. In a crisis, futures markets may decouple from physical reality. The premium on physical silver can explode, creating a parabolic surge. Simply put, silver is primed for a rapid, nonlinear move if systemic stress materializes. 5. Historical echoes. Lessons from the past. History repeatedly shows a pattern. Leverage builds quietly. Market confidence erodes. Sudden demand for tangible assets triggers extreme moves. The 1980 Hunt Brothers spike. Leveraged positions on paper contracts caused silver to nearly quintuple in months. 2008 financial crisis. Silver surged as investors sought safe havens, highlighting its dual role as commodity and quasi-monetary asset. Today, global debt, negative interest rates, industrial reliance, and leveraged paper markets are all more extreme than ever before. The system is effectively amplifying the conditions that historically caused silver to spike. 6. Psychological factors: fear, greed, and herd. Behavior markets are not just numbers, they are human behavior. Fear drives capital towards safe assets. Greed accelerates buying as prices rise. Herd behavior magnifies moves until liquidity is exhausted. Cause: investor psychology under stress. Effect: price spikes that can outpace fundamentals by multiples. Silver's affordability compared to gold makes it accessible to retail and institutional investors alike. This accessibility can accelerate buying pressure in times of panic. 7. The emerging Black Swan, unseen triggers in the system. So what might spark the next unforeseen surge in silver? Central bank policy exhaustion, rates near zero, massive balance sheets, and no conventional tools left. Shadow banking and derivatives overload, leveraged positions in the quadrillions, creating systemic fragility. Currency debasement, loss of confidence in major fiat currencies, could drive global demand for tangible stores of value. When these forces converge, silver is uniquely positioned to move faster, higher, and more unpredictably than any other asset. The parallels between historical silver crises and today's financial system are striking, almost uncanny. Debt, leverage, policy exhaustion, and supply constraints are converging in a way that could make the next silver surge not incremental, but explosive. The surge: how a black swan could unfold. We've traced silver's history and seen how modern financial pressures mirror past crises. Now comes the pivotal question: what actually happens when these pressures hit a tipping point? The answer is not gradual, it's explosive, and it begins with a sequence of predictable reactions in an unpredictable system. 1. Trigger event: the spark that ignites markets. A black swan event doesn't announce itself. It can be a sudden policy misstep, a corporate default, a geopolitical conflict, or even a cascading algorithmic failure. Cause: systemic financial stress hits a fragile leveraged network. Effect: confidence in paper assets erodes almost overnight. Investors scramble to protect wealth. Liquidity in traditional markets vanishes. Safe haven assets like gold and silver surge. Silver, because of its dual role as commodity and quasi-monetary asset, reacts faster than gold. Small amounts of capital can create outsized price movements. 2. Paper versus physical silver. The delivery mismatch. Modern silver markets are dominated by paper instruments, futures, ETFs, and leveraged positions. Physical silver is limited. It cannot be produced instantly. Paper contracts can represent multiples of actual supply. Effect: when investors demand physical delivery in a crisis, futures contracts may fail to settle as expected. Premiums on physical silver skyrocket. Prices spike faster than the broader market can absorb. Historical precedent: the 1980 Hunt Brothers silver squeeze. Leveraged bets on paper contracts collided with limited physical supply, causing a near five-fold price surge in months. Today, the scale is magnified. Global demand is higher and paper markets are more leveraged. 3. Leverage and margin calls, amplifying the surge. Leverage is a force multiplier in financial markets. Many silver positions are leveraged, meaning small price moves trigger margin calls. Margin calls force traders to sell positions, which paradoxically pushes prices higher when physical demand cannot meet paper claims. Effect: a feedback loop forms. Initial spike triggers margin calls. Forced liquidations create more demand for physical silver. Prices accelerate parabolically. This is the mechanism by which silver could surge not incrementally, but geometrically. 4. Psychological pressure: fear, greed, and herd behavior. Humans are wired to act predictably in crises. Fear drives capital toward perceived safety. Greed accelerates buying as prices climb. Herd behavior amplifies volatility beyond fundamentals. The effect: even small initial triggers can escalate into massive market moves. Silver is psychologically accessible due to its lower price per ounce compared to gold. This accessibility allows retail investors, institutions, and hedge funds to act simultaneously, intensifying upward pressure. 5. Cascading systemic effects. The surge in silver is not isolated. It interacts with broader financial systems. Weak or failing fiat currencies push more investors to tangible assets. Central banks may intervene, but intervention can weaken currency further, creating more demand for silver. Other markets, like equities and bonds, experience volatility as capital shifts to hard assets. This creates a cascading effect. Each reaction feeds the next, producing a parabolic spike in silver prices. 6. Historical echoes and modern magnification. Compare 1980 to today. Paper markets today are far larger and more leveraged. Industrial demand is higher, with limited capacity to increase supply. Global retail participation is unprecedented, amplified by instant online trading. The stage is set for a surge potentially larger and faster than anything in recorded history. 7. Failed fixes and policy limitations. Central banks might attempt to intervene to prevent panic, flooding markets with liquidity, raising interest rates, implementing capital controls. But here's the catch. Liquidity injections can weaken currency value, inadvertently increasing demand for silver. Restrictions can accelerate panic buying. Market participants may bypass interventions using global channels or cryptocurrencies to acquire silver. In other words, conventional tools may fail or even exacerbate the surge. 8. Scenario summary. The silver parabola. Trigger event. Systemic shock hits leveraged, fragile financial networks. Flight to safety. Investors move to silver for preservation of wealth. Physical demand. Mismatch. Paper versus physical creates delivery premiums. Leverage feedback. Loop, margin calls, and forced liquidations accelerate the surge. Psychological amplification. Fear, greed, and herd behavior magnify the movement. Cascading systemic effects. Other markets react, reinforcing silver's upward trajectory. Policy limitations. Conventional interventions fail or worsen the trend. This is how a Black Swan event could transform silver from a neglected commodity to the center of a global financial storm. We have traveled from silver stying's ancient origins to the modern pressures building in today as financial system. Now, let's distill this complex story into 3 clear takeaways, lessons that every investor, analyst, and observer should understand. Takeaway number 1. Silver is more than a commodity. Silver is not just a metal for jewelry or industry. It is a monetary barometer, a hedge, and a store of value that reacts to systemic stress. When confidence in paper money falters, silver does not simply follow industrial trends. It leads the flight to safety. Its dual role as commodity and quasi-monetary asset makes it uniquely sensitive to financial shocks. Lesson. Treat silver not as a passive investment, but as a gauge of broader economic and financial health. Takeaway number 2. Systemic stress is the real catalyst. The next silver surge will likely be triggered not by simple inflation or conventional market cycles, but by structural imbalances, excessive leverage in paper markets, shadow banking exposures, central bank policy exhaustion, massive global debt lesson. The conditions for explosive silver moves are already in place. Understanding systemic risk is key to anticipating potential surges. Takeaway number 3. Physical supply constraints. Amplify volatility. Silver supply cannot respond instantly to sudden demand. Industrial use, investment hoarding, and limited mining output create structural scarcity. When demand spikes, prices can rise geometrically, not incrementally. Lesson. Physical supply limitations can magnify the impact of systemic stress, turning a financial ripple into a parabolic surge. Warning. The Black Swan doesn't announce itself. A Black Swan event is inherently unpredictable. It does not send invitations, and it does not wait for readiness. History teaches us that such events hit when systems are fragile, leveraged, and overextended. Silver, as both a commodity and quasi-monetary asset, is positioned to react faster and more violently than most investors expect. This is a reminder. Preparation, awareness, and understanding of systemic pressures are as important as timing any investment. Trust, money, and silver's role. In a world increasingly dominated by digital currency, fiat money, and algorithmic trading, silver remains a tangible, universal store of value. The question is not whether silver will surge again. History suggests it inevitably will, but when and under what catalyst? Are we prepared for a financial system that could unleash a surge no one sees coming? Will silver once again act as the safety valve for human trust and money? These are the questions every investor and observer must consider as we navigate the next era of financial uncertainty. Like this video, if it opened your eyes to silver's hidden role in global finance, comment below. What do you think could trigger silver's next surge? Subscribe for deep dives into markets, history, and the forces shaping our financial future. Share this video with someone who needs to understand silver's potential in the next financial storm.